Today we are here to discuss the international manufacturing industry, specifically Nike. I am Brittany Booz, a fourth-year accounting major from St. Petersburg, Florida. Here with me are my colleagues.
I am Felicia Taylor, a third-year accounting student from Fort Lauderdale, Florida.
And I am Sydney Stargell, a third-year accounting student from Columbia, Maryland. Over the past 13 weeks, our audit team has been analyzing and evaluating the internal controls, financial statements, and the overall risk of the company and its industry. In this presentation, we will be discussing some of the significant accounts with their corresponding risk assessment and entity and process level controls. We also evaluated the control deficiencies that were present and offer some final suggestions for the company.
Now we will begin with the significant accounts from the income statement. Sales. Inherent risk was assessed as high because of the nature of the account. Sales is inherently risky because of the high volume of sales transactions that occur daily and the potential of misstatement due to failure of controls. The controls that were established were used to help prevent fictitious sales, ensure that sales actually occurred and are recorded for the correct amounts. This helps prevent false revenue recognition and alert management to review significant variances. Residual risk is assessed as high because of the important controls over monitoring failed. Thus, we increased residual risk for sales. This increase led us to implement new process level controls to help reduce the gap between internal controls and inherent risk. The next account we will address is cost of goods sold. Cost of goods sold is directly related to inventory. The reliance on judgment and estimates increases the risk of the account. The account is inherently risky in the manufacturing industry because of the potential for price increases of material used to produce products. Residual risk is assessed as high because of the nature of the account. We have determined that additional process level controls will be needed to help reduce the residual risk. These controls will help to detect any variances that would be cause for concern and should be addressed by management. The next account is general operating expenses. The overall assessment of this account is high. Expenses are often high-risk accounts because majority of the misstatements related to the income statement come from expenses being misclassified as revenue. With a large number of transactions for prepaid expenses, salaries, rent, and utilities, there is a potential chance that amounts are not accurately recorded or even recorded at all. The controls that were established were to help reduce residual risk is standardization. The standardization of journal entries prevent debits from not equaling credits. Another control is an independent person should review accounts for accuracy. If these controls weren't in place, a material misstatement could end up in the financial statements.
Now we will address the significant accounts on the balance sheet, starting with cash. The nature of the cash account makes it inherently risky. The large number of transactions cause cash accounts risk and makes it more susceptible to potential misstatements. The level of automation also makes the account risky and provides more opportunity for misstatements. The controls that were established to help mitigate inherent risk is to prevent against any manual error while entering into the general ledger computer system. Controls are also in place to review significant transactions by any independent person. Now we will talk about receivables. Assessed as a high-risk account, many factors are to be considered in relation to accounts receivables. In order for this account to be valued properly, the allowance for bad debt expense must be adequate. This involves judgment and estimates that could lead to potential misstatements. This account is established as a high because of high volume of transactions and the large amount in the account. Residual risk is assessed as a high because of failed controls, These controls were to help prevent receivables from being improperly recorded, such as accounts being written off as uncollectible when they have actually been received. The most important control that was established to help reduce the residual risk was the review of all aging accounts, analysis as well as significant transactions. The last significant account that we will address on the balance sheet is inventories. Inventory was assessed as a high for both residual and inherent risk. Inventory is more susceptible to fraud due to misappropriation of assets and theft, which is why there needs to be an increase in controls to prevent this occurrence. Valuation of inventory is extremely important and relies on the judgment and estimates, which increase the risk that inventory will be valued wrong and inventory will be considered obsolete. Residual risk will always be high for inventory. However, the controls were established to ensure that there was a safeguard to help monitor inventory, prevent material misstatements for an inaccurate valuation, as well to ensure that inventory in the system matches the physical count.
We will now discuss the control deficiencies that we deem to be a material weakness or significant deficiency, starting with control deficiency number 2. The company has ineffective policies and procedures for the period end financial close process. The assistant controller prepares a sub-ledger to general ledger reconciliation for all balance sheet accounts for the controller to review. The controller stated that accounts appearing to be inaccurate are investigated by the company. However, capital expenditures and research and development costs were found to be misclassified. Neither the controller nor assistant controller caught the misclassification during their review. We believe that the control deficiency is a material weakness. Both reviewers of the reconciliation overlooked the misclassification of capital expenditures and research development costs. There may be numerous times when the controller and assistant controller did not catch any inaccuracy. Even if one of them notices a significant variance, the company does not mandate that the variance should be investigated and resolved. Next is control deficiency number 3. The company does not have effective policies and procedures to match evidence of customer orders with shipping and invoice documents. This deficiency resulted in the overstatement of revenue and accounts receivables on the balance sheet. Also, the reserves for balances in accounts receivable were not calculated properly, and some customer balances aged beyond 90 days without sufficient follow-up. We believe that the deficiency is a material weakness because of the pervasiveness throughout the company and the insufficient follow-up of aged receivables. There is a reasonable possibility that the company's controls will fail to prevent or detect a misstatement. For control deficiency number 4, discrepancies with raw material vendor credits and customer order returns should be identified and adjusted based on authorization of the approval limits matrix by the RMA accounting department prior to a credit memo being issued. Testing showed that 32 credit memos were credited against the general ledger without authorization. We believe this deficiency is a significant deficiency that should be brought to management's attention. Even though the amount was immaterial and the investigation showed that no adjustments would be needed, the line items that could potentially be misstated, including accounts receivables, net product sales, and cost of goods sold, are too important for the deficiency to not be corrected. The control let 32 memos get posted without approval, so there is a strong possibility that it will fail to prevent or detect a misstatement. The last control deficiency we will discuss will be control deficiency number 5. Management determined that the company's policies and procedures did not provide for adequate management oversight and review of allowance for doubtful accounts. The accounts receivable manager believes he can just call any customer and get the over 120-day accounts paid off. We believe that this control is a material weakness. Allowance for doubtful accounts is not high enough to state accounts receivable at its net realizable value. There is also no policy for writing off bad debt. There is a high possibility that the company's controls will fail to prevent or detect a misstatement of an account balance.
Now we will provide you with some final recommendations. Through the analysis of Nike's industry, its business processes, internal controls, and risk evaluation, we have developed some helpful recommendations to improve the internal controls over financial reporting. To begin, we suggest that management increase its communication with Nike's system design specialists to better tailor controls to the needs of Nike and become more effective. This will prevent majority of the controls from failing and having an effect on residual risk. Next, we suggest to establish more independent checks. Many of the controls that fail rely on the check of one person, the controller, a manager, or an analyst. These safeguards help prevent a material misstatement, but did not prove to be effective. Establishing a second or third check from another independent person will increase the effectiveness of the controls and help decrease residual risk and potential for misstatement.
Another recommendation is to have manual and automatic calculations and recalculations of estimates and formulas used with the financial statement. This will ensure that all numbers are accurate and will help with consistency throughout the financial statement. Increasing controls over a period close procedures will help Nike maintain consistency in documentation, but more importantly, ensure that all transactions and reviews were conducted for each account on the balance sheet and income statement. Overall, we have determined that Nike has very little to improve on before the year-end visit from the external auditors.